All right, the presentation is about to begin. Thank you all for attending our fourth virtual event for Carmel Valley Manor. As a reminder, all attendees will have their cameras and mics automatically turned off upon entering the Zoom webinar. So if you're having any technical difficulties or have questions for our speakers throughout the event, we advise that you utilize the Q&A feature at the bottom of your Zoom screen. We will go through as many questions as possible for our speakers at the end of this presentation. All right, now please welcome Carmel Valley Health Services Administrator, Chris Regan.
Thank you. Thank you. Good afternoon, and thank you for joining Carmel Valley Manor's fourth Zoom event, Tax Tips for Retirement. We are happy to present information in this webinar that can benefit those over 65. Carmel Valley Manor is Monterey County's only life care community for those who have reached retirement age. This spring, we were named the best retirement community in Monterey County by the Monterey County Herald, and yesterday, Carmel Valley Manor received the U.S. News and World Report Best Senior Living Rating. We are honored to receive this recognition. If you haven't been to our beautiful 28-acre campus, I would encourage you to schedule a tour. It includes a stroll through the beautiful gardens, which this time of year looks like a flower show. And then today, our presentation about taxes and how retirees can pay as little as possible. They say taxes are a lot like golf. You work very hard to get to the green, and then you wind up in the hole. And those of you who play golf would know how true that is. With children grown and out of the house, many seniors consider downsizing. One of the challenges of downsizing is how to keep as much of the value you have created to live comfortably. We are fortunate to have an expert here with us today on the subject. Paul Gordon is a tax attorney and partner in the firm Hanson Bridget of San Francisco. Following today's presentation, we will have a question and answer session, followed by a brief introduction to Carmel Valley Manor by our Director of Community Relations, Angie Michau. If you have questions of either of the speakers, please click on the Q&A button and type them in. We will answer as many as we can get to at the end of today's Zoom presentation. And you can enter these anonymously if that's preferred. We are recording today's session and we'll be sharing the link in an email that you will receive following the presentation. Now, please join me in welcoming Paul Gordon. Paul?
Hello, everyone. Welcome to the webinar today. I've been working with the retirement communities since about 1975, since fresh out of law school, and at the same firm here, Hanson Bridget. And I do just about everything for retirement communities, including tax issues that are particular to retirement communities, which are really different in many ways than other kinds of tax issues. And so I'm not a full-time, some people in our tax department might take issue as to whether or not I am a true tax attorney, but I do a lot of work and have studied and have written rather extensively on tax issues that affect retirement communities and people who are considering moving into a retirement community. Slide, please. Okay, today I'm going to talk about three different topics. One is, all of which have tax implications. One is the sale of your home. A second one is the medical deduction the tax deduction for medical expenses. And the third one is tax deductible charitable contributions. So starting out with the home sale, as you all probably know, the gain that you make on the sale of your home is subject to tax. And the tax is a capital gains tax, which depending upon the amount of gain that you have could be 15 or 20% of your gain could be subject to a capital gains tax. It's probably going to be 20% for most home sales. And the tax is on your adjusted cost basis. It's the resale price of your home minus your adjusted cost basis. And your adjusted cost basis is the price that you originally paid for the house, the original cost, the original purchase price, plus the cost of any improvements. Things like maintenance don't count. But if you're improving the place by adding a room or doing remodeling that improves the value of the house, those are improvements, the cost of which you can add to your original purchase price. You can also deduct from the gain on the sale of your house some of the costs that go into reselling it. Obviously, things like brokers' commissions, if you repaint the house or do other things that are necessary in order to be able to sell the house, those are the kinds of things that can also be added to your original purchase price and whatever and the value of any improvements that you've made. Now, there is an exemption from capital gains tax on the sale of a home of $500,000 per couple. This is really a once in a lifetime opportunity to shelter some of that taxable gain from the sale of your house. It's only $250,000 for an individual, so $500,000 for a couple. And of course, it has to be the sale of your principal residence, one that you've lived in, and there's certain rules about how long you have to have lived there, but they're really easily met by just about everybody who is looking at selling their home with the thought of moving into a retirement community. So obviously what's happened over the years, I think everyone is quite aware that there have been really substantial increases in the value of homes over the years. And some people have lived in their homes for decades in the same home. And they might be a little bit shocked by how much of a gain they're likely to make on the sale of their home. And the tax consequences, because of that differential between what they paid for it and what they can sell it for, could be quite substantial. Slide, please. So let's take an example. Now, I don't know how exact this example is or whether it fits everyone's situation. Certainly, it's just an example, but I tried to be a little bit conservative on it. And so it's a hypothetical, but it illustrates this capital gains tax treatment and the application of the exemption that a couple would be eligible for. So let's suppose that you purchased your home in 1983. You know, that's a while back, what, 40 years? And you paid $650 for it. That's probably a pretty high price for 40 years ago, but let's go with it. If it was a lot less, of course, you're going to have even more gain than what I'm talking about in this example. But let's say you paid $650 for it. You made over the 40 years, $200,000 worth of improvements. And believe me, I just did this myself. You are going to go back and find every little receipt and everything that you've done. And in 40 years, it's not that unrealistic to have made that much in terms of cumulative improvements to your home over a 40-year period. So now today, let's suppose that you can sell that home in 2022 for $2 million. All right. And the way that you then calculate the tax is you take your $2 million and you deduct from that your cost basis. Probably should say their adjusted cost basis, because it's the original $650 that you paid, your purchase price, plus the $200,000 improvements that you've made over 40 years, meaning that you now have an adjusted cost basis of $850,000. You subtract that from the $2 million that you've received as a sale price for your home, and you have $1,150,000 of gain. A lot of money. Congratulations. Now you have a $500,000 exemption per couple, which you want to apply, leaving you with net taxable gain of $650,000. A big amount. You probably don't have that kind of gain or taxable income or any other kind of taxable amount in any year ever that even approaches that. Fortunately, the capital gains tax is quite a bit less than the tax on earnings. So it's 20%, but still you're looking at a tax in this example of $130,000, not an insignificant amount of money. Next slide, please. So let's talk now about the medical expense deduction. This may seem like an abrupt change from the sale of your home, but this medical expense deduction topic is going to tie in, trust me, it's going to tie in to the capital gains tax issue in a few minutes, because what you'd like to have is something that can offset that taxable gain from the sale of your home a little bit, or all of it possibly. And one avenue to do that is the medical expense deduction. Now, I would venture to say that there are not a lot of people who actually utilize this medical expense tax deduction every year or even ever. Why? Because the only part that is tax deductible is your out-of-pocket medical expenses that aren't covered by insurance, like Medicare, for example, or your Medicare supplemental policy, private insurance. So what expenses do you have beyond that? Those may be deductible, but they're only deductible to the extent that it exceeds 7.5% of your adjusted gross income for that year. There are not a lot of people around, unless you're pretty sick, who have 7.5%, more than 7.5% of their adjusted gross income as medical expenses each year. So what kinds of expenses are eligible for this deduction? Certainly physician visits that aren't otherwise covered, hospitalizations that aren't otherwise covered, but most of those other things are covered. Physicians, hospitals, it's covered by Medicare and your Medicare supplement private policy that you probably have that picks up the copays and the deductibles. But what isn't generally covered by Medicare and by most private insurance is assisted living and nursing care. Assisted living and nursing care are not covered by Medicare, and they're generally not covered by private insurance unless you have long-term care insurance. And I would venture to say that if you look at most long-term care insurance policies, they really don't cover much of assisted living or skilled nursing expenses. So the last bullet point here is, and I've already said it, is that many individuals really don't have a substantial enough degree of medical expenses to take advantage of this benefit unless they're already in a care facility full-time. And most people who want to move into a place like Carmel Valley Manor, they're not in a care facility full-time, and they don't want to be in a care facility full-time, unless they absolutely have to be. And so this point about the medical deduction and this opportunity to use the medical deduction to offset some of your capital gain from the sale of your house is an advantage or a benefit that applies to somebody who is seeking admission to certain kinds of retirement communities, not all of them, but only certain kinds, while they're still healthy and may have future care needs, but they don't have care needs today. Next slide, please. Okay, so Carmel Valley Manor is a kind of retirement community called a continuing care retirement community. They are heavily regulated by the state of California. The contracts are regulated by the state of California, and there's a lot of protections, consumer protections, escrows, and things like that benefit the consumers. This is an unusual type of financial arrangement insofar as it's not just a monthly fee like you would pay if you moved straight into an assisted living facility, or a daily fee like you would have if you moved into a skilled nursing facility, or even a monthly fee only, which is what you would pay in a typical independent living type of retirement community. One that doesn't necessarily have a care component to it. It just might have hotel types of services, housekeeping, laundry, recreational programs, dining, that sort of thing. But what makes a continuing care retirement community different is that there's also a promise to provide care in the future, which would include assisted living as needed and skilled nursing as needed for the rest of the resident's life. That is the difference that makes a continuing care retirement community different from and distinguishable from, let's call it a plain vanilla or average retirement community that doesn't have those benefits. And this is critical to the tax benefit that I'm going to talk about. Because Ccrc's, continuing care retirement communities, such as Carmel Valley Manor, they don't charge any kind of significant increase in monthly fees when a resident moves from their independent living apartment into assisted living or into nursing care. Now, how can you do that? Because if you think about it, assisted living, if you were just paying a monthly fee for assisted living, it would be substantially more than the monthly fee for independent living. And if you were in skilled nursing, it would be substantially more than assisted living to be in skilled nursing. So how is it that the fees that are paid each month can remain pretty close to the same fee when the person moves from independent living to assisted living to nursing as needed to get care in the future? Well, the answer is there's an entrance fee, and the entrance fee is sort of like a prepaid insurance policy in the sense that it can be used to subsidize the higher cost of providing care in the future. Next slide, please. Okay, so the Internal Revenue Service has quite a few rulings on this subject. all of which support the idea and the conclusion that this entrance fee is eligible, can be eligible in the right circumstances for a medical expense deduction in the year that it is paid. So now, if you have, if you're paying an entrance fee, and these entrance fees tend to run 6 figures, okay? And they're payable at the commencement of occupancy, or slightly before the commencement of occupancy, at the beginning of one's occupancy at the continuing care retirement community. And in the year that that is paid, a percentage of it should be deductible, and all the IRS rulings support this, as a prepaid medical expense. And so now in 1 year, you're very likely to exceed, you're almost guaranteed to exceed that 7.5% of adjusted gross income threshold that you could never exceed in prior years. And you may never be able to exceed it again in the future unless you move full-time into assisted living or full-time into nursing. So here's a once-in-a-lifetime opportunity to take advantage of this medical deduction. And so what's the amount of the deduction? The amount of the deduction is a percentage that, and again, the IRS has approved this methodology. It's a percentage that represents the continuing care retirement community's cost of providing care as compared to its total costs of operation. And that's something that the Ccrc management determines internally. They'll look at their budget, they'll look at their operating expenses, and they'll determine that X% of what we do every day goes to providing assisted living to the residents, providing nursing to the residents. That's the numerator of the fraction. The denominator of the fraction is everything we do, including care, but also all of the dining and housekeeping and recreational programs and all of the services that go to the independent living apartments. That's all the denominator, the bottom part of the fraction. So that percentage can be applied to the entrance fee. And that same percentage also can be applied to the monthly fees as a deductible medical expense. It is not unusual for that percentage to be as high as 30%. So, and we'll use that as a rule of thumb. It's not a rule, and it can change for every year based on actual operating expenses of the community. And that's a number that is usually given by the Ccrc management to the residents each year. And then the residents go and talk to their accountants about how you declare that on your tax return. Next slide, please. So here's an example of the Ccrc medical expense deduction. Let's suppose, as a hypothetical, that the residents' adjusted gross income at the time of their move-in to a Ccrc is $250,000. Let's assume also, and it's 2022, and assume that in 2022, they also pay an $850,000 entrance fee to a continuing care retirement community. Let's also assume that they're paying a monthly fee of $5,000 per month, which is $60,000 per year. And then, as I previously mentioned, let's take a 30% as the number that represents the cost of the Ccrc providing care to all of its residents. That's the numerator of the fraction. And the bottom is 100%. It's everything that we do. So the 30% represents the percentage of total operational expenses devoted to providing care. So here is the deductible medical expense in the first year that the resident moves into the Ccrc. They've paid an $850,000 entrance fee. 30% of that is $255,000. A very large deduction. And then 30% of their $60,000 per year of monthly fees, also deductible, another $18,000. So now we have to deduct from that the total of those two numbers. We have to deduct 7.5% of their adjusted gross income. So that's 7.5% of $250,000. That's the part that's not eligible for the medical deduction. You have to exceed that amount. So when you add up 255 plus 18 and you subtract 18,750, you end up with a net medical expense deduction in 2022 of $254,250. A pretty good deduction that you will never see again in your life. I venture to speculate. Next slide, please. Now, what we haven't done is gone back to the previous slide where I think we had, what was it, about 130,000 go back and look at the slide. We had $130,000 of capital gains from the sale of the home. And so now with this medical expense deduction, you have easily erased that, plus been able to apply it, the rest of it, toward the adjusted gross income that you've earned in that year. So you're not going to be paying a lot of taxes in that 1 year. The third subject I want to talk about much more briefly, and it's less complicated really, is that of charitable contributions. Carmel Valley Manor is a 501c3 charitable corporation under the federal tax exemption laws that is eligible to receive tax deductible contributions. It also is eligible under the state law to receive state tax deductible charitable contributions. The kinds of contributions that can be made can be really for just about any purpose that is served by a charitable corporation like Carmel Valley Manor. Sometimes the money could be used to subsidize other residents who run out of funds, which does happen because as a charitable organization, Carmel Valley Manor has an obligation to have some way of assisting residents if they, despite being financially qualified when they move in, if they live to be 100, they may not be able to pay the monthly fees at the end of their lifetimes. And so Carmel Valley Manor, like all nonprofit continuing care retirement communities, has a program that is designed to assist people who run out of funds. But of course, there's financial screening when you first come in, and there are entrance fees and other ways to protect against insolvency on the part of the corporation. So, but nevertheless, many residents do make charitable contributions, sometimes to assist their neighbors who are become their friends and neighbors. So it could be for general corporate purposes, to remodel the lounge or something, or it could be to help subsidize other residents who run out of funds. There's a couple of different ways of doing it. One is, of course, a direct contribution, which can be made at any time or not. This isn't a solicitation to make a contribution. This is just information about taxes and tax deductions. So that's one way to get a tax deduction. Another option that I have to confess I am not really qualified to talk about too much, because there are people who really specialize in this, is the charitable remainder trust. It's an estate planning type of tool, and you should always talk to an estate planning attorney about it. But what it does is it allows a contribution to be made now that the contribution is put into a trust, but it remains in the trust during your lifetime. And you get, and so it doesn't pass over to the charitable organization during your lifetime. It only passes over to the charitable organization at the time of your death. And meanwhile, while you're still alive, it can earn income. And you can get a tax deduction based on the earned income and based on the original contribution. Not all of it, but a percentage of it, which is calculated each year based on your actuarial life expectancy. And the IRS produces tables that will tell you, or tell your accountant or your estate planning attorney, how much is deductible in each year for the rest of your life. So that's a good way to make a contribution where you get a charitable deduction. You're still able to get some benefit of those funds while you're still alive, and take a charitable contribution tax deduction based on your life expectancy over a period of time. Okay, so when I was asked to do this, one of the organizers of it said, "Can you lighten this up and do a tax joke?" And I said, I have never in all my years of practicing law heard a tax joke. Most people don't think it's a very funny topic, and so I don't have any tax jokes. But since we were just talking about a minute ago, we were talking about life expectancy tables. The people who do that are actuaries, and I do have two actuary jokes, so which I'm now going to inflict upon you all. One of them is, what's the definition of an actuary? Answer: an actuary is a person who started out wanting to be an accountant, but didn't have the personality for it. Okay. Too bad you're all muted. The second one is, what's the difference between an introverted actuary and an extroverted actuary? And the answer is that an introverted actuary, the whole time you're talking to him, he's looking at his shoes. Whereas an extroverted actuary, the whole time you're talking to him, he's looking at your shoes. So thanks very much. That's my presentation for today.
Oh goodness, Paul, thank you so much. That was great, and I did like the jokes. That was informative. Thank you. And now I'd like to open it up to some questions.
Yes, and Chris, I can take that over from here. So while Paul was giving his presentation, we did get 3 questions. And if you do have any questions that you think of in a few minutes, we'll still be watching the Q&A and can ask Paul to answer them at the end. But I'll begin with the first question we got from Mike. He said, capital gain on house, do you have to take into account principal residences that you rolled into the current principal residence under the prior law when calculating gain?
I'm not sure exactly what the question is, but I think that it may be about what your cost basis is in your home, in your principal residence. And my understanding of it is that the law has changed in that area in recent years. It used to be that if a senior transferred, and this is really a property tax issue. It's not an income tax issue. It's a property tax issue, that you could roll your cost basis over from one home to another when you moved between originally it was only certain counties that had this reciprocity where you could roll over your lower tax basis from the cost that you paid originally for your home and had, let's say it was a low amount and you had low property taxes in that county. Then you moved to a different county, and certain counties had reciprocity agreements where the county that you moved to would allow you to carry over the low cost basis from your old county to your new county, and then you wouldn't be taxed as much in the new county, even though the value of the house had appreciated quite substantially in the meantime. That law, which used to only be between certain counties, is now statewide, as I understand it. And so therefore, everybody, all seniors, are able to pass their low cost basis from the original I'm reading pop-up things which are a little distracting, that the low cost basis from the prior county can be carried over to the new county so that you don't have to pay as much in property taxes during your lifetime. But you still have to, when you sell that house, you're still going to have capital gains that are based on, as I already said, on your cost basis in the house, adjusted and then deducted from your sales proceeds. And that's an income tax, not a property tax.
Great. We actually have many questions coming in here, so I'll try to get through as many of these as we can. Next, there was a question from Carol. Are capital gains from selling a home included in calculating the AGI? Does this affect the 7.5% that medical expenses must exceed to get a medical deduction for the entrance fee?
Wow, I'm not sure that I know the answer to that off the top of my head. That might be one for your accountant. I do think, though, that the capital gains are treated differently than income. Well, it's just taxed at a different rate, so it probably is income that would affect your adjusted gross income. I think you should talk to an accountant about that.
Great. Then next, David had the question, if you can't find all the receipts for home improvements, can you estimate the value of those improvements? Is that acceptable?
Well, I think you can. I mean, again, that's something that, I've heard it said that your tax return is a first offer. Look at it as a first offer or your best offer. You're always subject to audit, and if you're audited, the IRS is going to want to see receipts. So the best practice is always going to be to have receipts for everything. But if you have other means in an audit situation where you can demonstrate the value of what was done, or the cost, it's a cost issue, it's not a value issue. it's a cost issue. So if you can demonstrate that it costs a certain amount of money, whether you physically have a receipt or not, I think it's still going to be eligible for adjusting your cost basis.
Okay, great. Next up, Mike McCarver, he had the question, the capital gain of 20% is just the US. California is 11 to 14%. Is that correct?
I don't know the percentage, but yes, California is in addition to that.
Okay. Another question received, how are the deductions handled for California taxes? Are they the same as the feds?
My understanding is that that California also observes the federal rule in terms of the amount that can be sheltered. In other words, the $500,000 that can be sheltered from capital gain, that also applies to your California taxes.
Okay. Great. And then I'm going to answer a couple more here. We have a few more slides to share with you. So towards the end, we can answer as many questions as we can that are relevant to Paul after that. But just looking at a couple more here. Prior to the current capital gain law, you would roll over your gain to the new residence?
The rollover that I was talking about is not a rollover of gain. It's a rollover for property tax purposes of your cost basis in your home, which is the basis on which property taxes are assessed. So if you, let's say you bought a home in a rural county 30 years ago, and it was very inexpensive, and your property taxes were based on that very low valuation. Then you moved to a different county, and meanwhile, your house had appreciated greatly, so that if you had to pay tax on the appreciated value of that house, your property taxes would be considerably more. But if you're over 65, it might even be 55, that you can still keep that low cost basis from the original purchase of your original house. You can carry it over into the new house and be taxed in the new county for the lower value of your original house. So you don't get that step up in appreciation that ends up increasing your property taxes. So it isn't a rollover of gain. It's a rollover of the valuation of the house, the original cost of the house, for purposes of valuing it for property tax purposes in the current year.
Okay, great. And then from an anonymous attendee, this person is asking, can you rent your former primary home after moving to CVM and still be eligible for estate tax step-up basis when you die?
I think there's a limit on it. I think that in order to, in order to take advantage of the $500,000 exempt amount from the resale of your home, you have to have lived in the home. I think it's for 2 of the last 5 years. It has to be your principal residence. So there's a limit on how long you can be out of the home, not living there, and still take advantage of that exemption from capital gain as your principal residence. The capital gain exemption is only applicable to your principal residence. And if you haven't been living there recently, then, and I think it's a 2-year limitation, then you are not eligible for that exemption.
Great. We do have a few more questions, but at this time, I'm going to just hand it back over to Chris so we can wrap up the last few slides of this presentation, and then we'll return to the Q&A at the end and hopefully can cover all of those.
Oh, thank you, Paul and Julia, for that. That was, again, great questions and answers. So now I'd like to introduce Carmel Valley Manor's Director of Community Relations. This is Angie Michau, who will share any additional information and slides about Carmel Valley Manor. Thank you, Angie.
Thank you, Chris, and thank you, Paul. Carmel Valley Manor is a nationally accredited life care community offering 3 levels of care and support to our residents. They include independent living, assisted living, and skilled nursing. We are the only life care community on the Monterey Peninsula. Our 214 residents are served by a staff of nearly 170. That's an amazing ratio of staff to residents. I would like to share a little more information about the range of services our residents enjoy on this beautiful 28-acre campus. We have 48 members of our dining staff, which includes chefs, a wait staff, and a dietitian. It's like a private gourmet restaurant that serves 3 delicious meals a day. There are 6 gardeners who are constantly caring for new plantings and the changing of our seasons. Matt Burke is our personal trainer, and Mercedes Ablutin is our physical therapist. We have a fitness center complete with a weight room, cardiovascular equipment, and a hot tub, as well as a physical therapy facility in our health center. We have approximately 24 nurses and caregivers in our skilled nursing and assisted living facilities, so we are prepared for most urgent care needs as well as long-term care needs. This year, Dr. Pablo Veliz became Carmel Valley Manor's new medical director. Dr. Veliz also serves on the medical staff of Montage Health Group. This affiliation has allowed us to continue to raise the bar on senior health care. We have 21 wonderful housekeepers providing weekly service, 2 drivers to take people to appointments, and a team of maintenance engineers. It is like living in a resort. When someone or a couple is interested in moving here, they schedule a tour, which is sometimes accompanied with lunch. That, along with the tour, is a great way to get to know us and for us to get to know you. Upon acceptance, you have the choice of one of our available residences, or you can join our wait list. We currently have a variety of 1-bedroom and studio apartments with garden patios available. This is our model home, which has been upgraded with a new modern kitchen. We currently have a variety of incentives on our quick move-in homes. We also offer a new contract option. We are surrounded by hundreds of acres of open space, including ranches, farms, vineyards, and sweeping views of the valley are spectacular. We have an exciting update coming to the common areas of our campus currently underway. Here is the reception area before and after. Here's the lounge. The architectural firm SOM originally designed Carmel Valley Manor in the 1950s. This is the central lobby and the area used for group gatherings. Next is our dining room before and after. As part of the renovation, we will be adding a new casual dining bistro. Next is the patio gathering spot, before and after. We expect to have everything completed by the end of the year and are very excited to see these changes. This beautiful sunset was also taken by Will Furman, one of our many photographers and artists here at the Manor. If you are interested in more information or if you'd like to schedule a private tour, please contact me. I'm Angie Michau. And as mentioned, we have a spring special going on now. I'd be happy to provide more details if you'd like to give me a call. Thank you for joining us today.
Angie, thank you very much. That was wonderful. We'll be sending a follow-up email with a short survey along with a link to the video for today's event. Please fill out our survey as your feedback will help us improve future presentations. Thank you again for joining us. And now, next we'll head to your questions and answers. It's not too late to ask a question on your own. Just type it in the Q&A at the bottom. Julia?
Great, thanks so much. So returning to our questions, I know many of them are for Paul, naturally. So I'll kind of start at the top and just continue down. And as Chris mentioned, if you have any questions specifically for Angie or Chris pertaining to Carmel Valley Manor, they'll be happy to answer those questions as well. Returning to that list. So Martin is asking, how does one qualify types of improvements such as a new roof, etc.? How far back can the improvements have been?
I think the improvements can go back to the date of purchase. It doesn't matter how remote in time they are. So all the improvements you made while you were living there are eligible for increasing your cost basis. And by the way, there was an earlier question which I didn't have a firm answer to, and I looked it up, and it was the question about whether the sales proceeds from your house that are subject to capital gains, whether those are included in your adjusted gross income that year. And they are, even though they're subject to a different taxation rate, which is, the 20% versus whatever your income tax rate might be. It's still part of your adjusted gross income in the year of receipt.
Great. Good. And then moving on to the next questions, we had a question from John Webster. If you leave your property to your heir, do they get a stepped up basis to date of death, or has that changed? I understand that heir must now make property their primary residence within 1 year in order to avoid capital gain on sale.
Yeah, if you, my understanding of it, again, and this gets into, I think it's mostly a trust law issue, which is that if you have a revocable trust and your home is in it, then you're going to be taxed whether the same as if it were not in your trust. But when you die, that revocable trust becomes irrevocable. And if your beneficiary inherits the property, then the beneficiary does get a stepped up tax basis. But again, I have to say that I'm not an accountant. You really should talk to an accountant about these issues. And my area of focus has really been in the area of the medical tax deductions as it relates to continuing care retirement communities. That's the topic that I've written about quite a bit.
Great. Another question from Barbara Calloway. She says, I foresee eye rolling in the head of the EA that does my taxes. Can you give me a specific reference, IRS or otherwise, regarding the deduction for the care cost percentage from monthly fee and entrance fee?
Yeah, I wrote an article, a fairly long article that was published by the American Seniors Housing Association on that issue. And it has all the citations to all of the IRS revenue rulings and private letter rulings on the topic. I think, Julia, doesn't your office have a copy of that somewhere? And I'm wondering if it could be made available to people who ask for it.
Sure. Yeah, we can do that. I do know that Marilyn, someone who is participating, asked for the slide presentation following this webinar. So we'll be able to provide that as well as this recording and that article that Paul just referenced. All right, great. Moving over to some questions about Carmel Valley Manor. GPs is asking, do you have vegetarian options for the daily meals? Chris or Angie, you want to take that one?
We do have vegetarian options. That's something that we've recently jumped into. Carmel Valley Manor is also a blue zone, so we're looking at all different types of meal options, but vegetarian is definitely one of them.
Great. Mike asks, Angie, what's the current wait list time for the various residences?
It really depends on the type of unit. If you're looking for anything that is a 2-bedroom or larger, it's realistic to say it's somewhere between 2 and 5 years. If you're interested in a 1-bedroom, we do have 1-bedrooms currently available. So it would just depend on the unit type you're interested in.
All right.
For the person who is asking a minute ago about IRS citation supporting this idea of a percentage of medical expenses being deductible in a continuing care retirement community, just as a starting point, the citation is IRS Revenue Ruling 75-302. 75-302 Revenue Ruling supported a 30% medical deduction for an entrance fee at a continuing care retirement community.
Great. And another question in regards to wait time for residences. Rex Pay is asking, what is the waiting time for a 1 or 2-bedroom residence?
As I mentioned, for a 1-bedroom, we currently have 1-bedroom units available. For the 2-bedroom units, you're looking at possibly a 2 to 5 year wait time, depending on the size of the 2-bedroom you're interested in.
Great. So Rex, we'd probably recommend that you get in touch with Angie specifically, and you can get some more information about the current availability for the 1-bedroom residences. Right. And I will include her email address in the chat here, so that's easily accessible. Okay, one more question here. Can one of the spouses be under 65 when applying for admission as a couple?
When applying, yes. Typically, when someone enters the manor, we like to see the person be 65 or older to be of Medicare age. It gets a little complicated when it comes to the medical care if someone is below 65. But yes, you can apply when you're 64 and under.
All right. We'll cover one more question. While we answer this question, I'm going to flip back to the slide here with Angie's email address and phone number. So feel free to jot those down if you would like to reach out to her separately at another time, and she can answer any specific questions for you. But last question we'll cover for this webinar. Do you offer rental units for visiting family members?
Yes, we currently have 7 guest units available. It's first come, first serve. But they are equipped with a queen size bed and a pull-out sofa sleeper, so they're great for families to visit.
Great. All right. Well, thank you everybody for joining us. As I mentioned earlier, we will be sharing these slides. I know a few of you have requested that. We will provide the slides as a PowerPoint. We will provide this recording later this week. And then I believe Paul mentioned that there was an article that might be helpful pertaining to the tax segment of this presentation. So we'll be sure to share that as well. So thank you everyone for joining us. And thank you, Paul, Angie, and Chris for all of your wonderful answers for everyone. And we hope to hear from you all soon. If you have any other questions about Carmel Valley Manor, As I mentioned, you have Angie's contact info, but you can always go to cvmanor.com if you have any other questions.
Thank you.
Thank you.
Thank you, everyone.